In our next example, I'm not going to write out everything because you've now seen the process that follows. The solutions are still the same, so I'm just going to talk about it so we can get through the core principles a bit faster. So example 3 says, this example shows the treatment of a lump sum that was received over 2 years, and both of them are retirement lump sums in this case. Okay, so let's go. Mr. A worked as a CFO for A Limited. The information for 2 years are presented, and you are required to calculate the tax for both years. So I'm going to do year 1 first, then we'll do the next year. So year 1, he earned a salary of 70,000 rands a month until November of the current year. So guys, our normal tax, salary, there we go. Very simple. He retired from his employment on the 30th of November, and he received a lump sum from the company's pension fund of 4 million rands. So under your lump sum calculation, 4 million rands. Right. He contributed 10% of his savings to the pension fund, so that's our section 11F deduction. We'll get to that. The total contributions to the pension fund that were disallowed in the past were 900,000 rands. Right, so guys, make sure that you see contributions disallowed to the pension fund, 900,000 rands. From the 1st of December, he became entitled to an annuity of 30,000 rands a month from the pension fund. That is what you see there under our normal tax. He also contributed 6,000 rands a month to the RAF, right? So that's part of section 11F. And the contributions disallowed to the RAF in the past were 800,000 rands. Now, we have a lump sum calculation in the current year. Remember, this disallowed amounts, the order, lump sum, annuity, section 11F. So you go, do we have a lump sum? Yes. So that 800,000 must be set off against the lump sum. Now I want you guys to make sure that you see, so the issue is what some students will say here, is now we have a pension fund. Well, we have a pension fund lump sum. Why are we deducting that 800,000 rands against the pension fund lump sum? It's because the Act doesn't see it in that way. They just see it as retirement lump sums that you've received. Right, so you need to deduct it against the lump sum. Right, so that's the end of year 1. So we add up everything under our normal tax. We then do our section 11F deduction. Right, same way as usual, claim our deduction. Right, tax per tables, primary rebate, then we have our tax on our lump sums. Where does that come from? It comes from our lump sums calculation. Alright, so now see year 2. So in year 2, he still contributed 6,000 rands a month to the RAF, because remember, he got his lump sum from the pension fund but not the RAF yet. He then ceased his membership of the RAF. He received a lump sum of 5 million from the RAF, and from the 1st of September, he became entitled to an annuity of 45,000 rands. Right, so let's look at year 2. Let's start with the normal tax. So the normal tax, first thing that you need to remember is that pension fund annuity he started getting in year 1, he now had it for the entire year. And then he had the RAF for 6 months of the year. Okay. He received a lump sum. Make sure that you see now, this is very interesting how, or not interesting, important, maybe it's interesting as well, 5 million rands in year 2. Okay, so make sure that you see now what happens in year 2 with our lump sums. So you look here, lump sum, current year, there's the 5 million rands. Prior year, there's the pension amount. Right. Contributions disallowed, prior year was 1.7 million rands. Where did that come from, guys? If I take you back to year 1, the contributions disallowed there in year 1, the 900,000, 800,000, added up, 1.7 million rands. That is why we are seeing that deduction there. Now, make sure that you see, you calculate your tax per your gross income, calculate your tax per the retirement table. Now, important. You go. Now we have to do our hypothetical tax. So guys, see what you do for the hypothetical tax is you look for everything that was prior year. So prior year pension, 4 million rands. Contributions disallowed, prior year, 1.7 million rands. Transfers to other funds, prior year, null. Okay, so there we go. 4 million, 1.7, null. So basically what I want you to see is this calculation that you perform here for your hypothetical tax, that 2.3 million rands. If you go back to year 1, can you see it's last year's taxable income for the lump sums? It's last year's. Because you're reperforming this calculation. So you're trying to say, how much was the lump sums in the past? Now, this is just because they were in 2 years, you would add up everything in the past that there was. Right, so you say 2.3 million rands was the amount. What is the hypothetical tax that I would pay on that using today's tax table? So whatever tax table you used over there, you must now use over here. And in this case, in both instances, it would be the retirement table that you use because you're currently retiring. And that is what you then deduct. Now this 580,500, if I go back to year 1, you'll see that's the same amount that you calculated. Now guys, please remember, that is not, you mustn't see it as it must be the same as the last year's amount. It's not. You have to calculate it using the tax table that you're using today. So it is just pure coincidence that they work out in this way. Alright, compare that now to the next one, example number 4. So in example number 4, we do two things. We say we've got now lump sums in different years. One of them is a withdrawal and the other is a retirement lump sum. Okay, so year 1, Mr. earned a salary of 70,000 rands from A Limited. He contributed 10% of his monthly income to the Provident Fund and also 6,000 rands a month to the RAF. Okay, so year 1, let's just quickly go. There's his salary that he received. Right, he had it for the entire year. On the 1st of December of the year of assessment, he withdrew 4 million rands. So he did not retire, he withdrew 4 million rands as a lump sum from the RAF. And then discontinued with his contributions to the RAF. The RAF contributions disallowed in the past was 1.4 million rands, and the contributions to the Provident Fund that were disallowed before this year amounted to 2 million. Right, so guys, your current year RAF, and I just want you to see the principle over here. The current year RAF, 4 million received, less your contributions disallowed for the Provident and the RAF. Right, there are some stories about Provident Fund not necessarily being allowed. It's not as important for you guys at this point in time. So treat it in this similar fashion as we've done here all the time. Right, so you deduct it, transfers to other funds, null, right. Gives us our income, and then that's 600,000 rands in your lump sum. We've withdrawn it. You need to calculate that using the withdrawal table. So where does it sit in our withdrawal table, guys? It is 600,000 rands, so it sits over here. Right, so we calculate tax of 103,500. Now it's important, I'm going to just take this out. A little circle there and remind you of that 103,500. Now, under your normal tax, guys, you obviously now do your section 11F, get your deduction, and so forth, and there's your tax on the lump sum, 103,500. Okay, we use the withdrawal table. Now, see what happens in year 6. In year 6, he had a salary of 85,000 rands a month. He retired on the 30th of November. Okay, so I'm just going to take you down to year 6. He received his salary, 85,000 rands a month. Okay, then they tell you he retired. He contributed 10% of his salary to the pension fund. He became entitled to a monthly annuity of 50,000 rands. Let's just get that monthly annuity. There we go. Right, then the total contributions to the Provident Fund that were disallowed since year 1 up to the beginning of the current year is 200,000 rands. Now guys, what is this trying to show you over here is just the following. This, in year 1, we said the contributions that were disallowed were 2 million rands. Now we're saying it's 200,000. So it means from year 1 to year 6, the total amount that has been disallowed since then is 200,000. So that means in total it was 2 million plus the 200,000. This is important because you've already taken the 2 million into account in year 1. So this is just to allow you to use the movement in year 6, as you'll see. The Provident Fund paid out a lump sum of 9 million, and he transferred 2 million of this to the lump sum for the Provident Fund. Right, so now guys, we go to year 6, look at the lump sum. So lump sum first up. In the current year, we received 9 million rands. In the past, year 1, we had the 4 million rands. So I'm just going to take you back to year 1. Remember, this is year 1. There's the 4 million. Right, less the contributions disallowed of 3.4 million rands in year 1. There we go. So prior year, can you see? Current year, there's the 200,000 rands that we just spoke of. Less the transfers to other funds gives you the gross income. You calculate your tax on this using what table? The retirement table. Why? Because in year 6 you retired. So you use the retirement table. Make sure you see we use the retirement table. Now, less the hypothetical tax. So what is the hypothetical tax, guys? The hypothetical tax is everything in the prior year. Prior year, prior year, prior year. Can you see? 4 million, 3.4 million, and 0. So you say, what was the taxable income in the prior year? 600,000. Now you say, the hypothetical tax on 600,000 rands using the same table that I used above. What table did I use there? The retirement table. What table did we use? The retirement table. So you use the same table to say, what is the tax then on 600,000 rands? Right. And just to show you, that then calculates 18,000 rands. Now, guys, make sure that you see, and this is what you need to compare to the previous example. This 18,000 rands in year 6, if I go back to year number 1, the actual tax I calculated in year 1 was 103,500. But now I'm only getting a deduction of 18,000. Why? Because we use different tax tables, and you must use the most recent tax table, which is what you can see there. Right, so that 239,500, where does it go? Goes to my normal tax, as before. And that is pretty much how the lump sums work.